What's going on, YouTube? I'm usually over on TradeUI showing you how you can use their software to give yourself a trading edge. However, today I actually wanted to take a step back and explain to all of our new people out there what exactly a stock option is. And we're going to go through just the basics today and show you how you can use TradeUI's platform to go ahead and get started trading stock options. So, first off, right off the bat, what is a stock option? Well, by definition, an option is a contract giving the buyer the right but not the obligation to buy or sell the underlying asset in which the contract is associated with at a specific price or before a certain date, which would be the date of expiration, that 100 shares of that contract represents. So, say if Apple has a stock options contract for $150, well, that contract represents 100 shares of Apple at $150. But the beautiful thing is, for people with not a lot of capital, trading options actually gives people the opportunity to buy stock options, or gives traders the opportunity to buy these Apple assets at a discounted rate, because they don't necessarily have the ability to buy 100 shares of Apple at $150 per share, but they do have the ability to buy certain option contracts that are significantly cheaper and gives yourself the same buying capabilities as other investors who buy stocks long term. So, the types of options that we have our call options. Is when you buy a call option, you're buying the right to purchase from the seller of that option about 100 shares of a particular stock at a predetermined price, which is called the strike price. All right, so call options are highlighted in green because that's bullish. You would be buying that option because you think the value of that option is going to increase in value. So that's why I put a green highlight there for the options, is because, or for the call options section, because you think that the price of that call option that you buy is going to increase in value. So, for example, you see strike price right here. If the strike price of that contract is, say, $150 for Apple, and you think Apple is going to go past $150 per share, you would be inclined to buy a call option on Apple. So the complete inverse, which is a put option, is when you buy a put option, you're buying the right to force the person who sells you the put to purchase 100 shares of a particular stock from you at that strike price that they purchased the put option. So we'll do an inverse. We'll say you think Apple is going to go below $120 a share. All right, say it's trading at $130 right now, and you think it's going to go down to below $120. So now you'd buy a put option indicating you think that Apple is going to be worth less than $130 before the expiration date of that contract, and the difference between the price that Apple's at as well as the actual strike price itself is obligated to be sent to you by the seller of the put option. Now, all of this money is actually factored into the trading broker that you use. Once the contract is done, they actually hold money to give you your returns on your investment. So say if I were to sell Joe a put option, Joe, once I sell the put option, I take on risk that I owe the institution I trade the option through. I personally don't have to go pay Joe $20 if my put option actually decreases in value and owe him money. I actually will owe the institution money, and the institution will pay Joe for his return on investment, and vice versa for myself. Also note, the stock options are purchased in multiples of 100. We mentioned this earlier. So for example, if a contract for an option is listed for $1.50, that means that contract, you actually have to pay $150 for that contract, because you're buying 100 contracts of that option contract for $1.50 per contract. So I also have a couple of factors that you want to consider when you're actually getting into options. There are three big things that I've realized are the big ones that people need to understand when it comes to deciding what options they need to buy or sell. First is the strike price. All right, the strike price is the set price at which the owner of an options contract can buy or sell the underlying security. So if I buy an option contract for Apple and my strike price is $100, whether Apple is above $100 and say it's at $150, or say it's below $100 and it's at $80, I'm obligated to pay for Apple contracts at $100 per share. So I can immediately sell those contracts and collect a $50 profit per contract if Apple goes to 150. However, if Apple goes to 80, I owe $20 per share on however many shares my option contract represents me owning. All right. The next one is DTE, also known as days till expiration. And this is the amount of time the option contract actually has until its expiration. So some option contracts are 2 days. So you have 2 days for that contract to move up or down in price. Or some can go as far out as 874 days. They can go out for multiple years. Those are necessarily known as leaps. Most of the time, you'll see people trading anything from 2 days to 90 days in that range. It just depends on your trading strategy. However, basically what happens is if I buy a contract, a call option for Apple at $100 and it expires in 2 days, if Apple is trading at $105 at the end of those 2 days, I'm obligated to purchase 100 shares of Apple at $100 a share, which immediately gets sold for $105 a share, and the difference in price goes into my return on investment. All right. The next thing I have is delta. Delta is the theoretical estimate of how an option's value may change given for every dollar move in the security. So you might want to close out your option contract early because, say, Apple goes from trading from $100 a share to $150 a share over the course of 2 weeks, but your option contract is actually for 90 days. Well, example, if the contract has a delta of 0.5 or 50 cents, the actual price of the contract will increase 50 cents per dollar the associated stock moves. So say a stock moves $10 a share, goes from 100 to 110. Your contract that you purchase actually increases 50 cents per share. So if you have an option contract for $1 that represents a stock trading at $100 per share, say that stock moves $5, well, your contract will say is worth $1.50. So you're in at $150, but if with a delta of 5 and it moves $5, so now the price of the stock is trading at 105. You just had an option contract value go from $1.50 to, let's see, I think it's $3.50 if you do 50. I'm sorry, it's what is that? That is actually $3. Yeah, it goes up to $3 per contract. Therefore, you made 100% return when the actual stock only moved $5 per share. So everybody else holding stock only made a 5% return. However, you just made a 100% return because the value of your contract just increased by 100%. And yeah, so that's the actual end of the actual presentation I threw together. But I wanted to show y'all something else. You can actually use TradeUI's scanning system to determine what contracts you actually want to look at. So what you can do, you can actually filter out to see what people are buying. So if you go right here, this is actually the fill. So I have the ask, bid, below bid, opening, and above ask. If you set it to ask, you can actually filter out and see what people are starting to enter. Down here, green represents bullish indicators, purple represents neutral, and if we make it bigger, there actually is no red overall indicators for the ask. So that's actually a really good sign. So if we're looking on the call side, we think the stock's going to go up in value. Well, look, so AEHR right off the bat, there's $4 million on the call side for this one. The days till expiration is 455 days. Now, these are deep in the money strikes. So no matter where this stock goes, these people are obligated, if they hold the contract till its end, they're obligated to buy this stock at $2.50. So they will buy that, and they'll buy 100 shares for each contract they own. They currently have right here $352,000 worth of contracts just on this order alone. However, what you can do is you can look at this data right here to determine what direction you think a stock's going to go. So these guys think AEHR is going to be bullish over the next 455 days. And they're betting really hard. They're betting, like right here, they're betting over almost $500,000. They're betting several hundreds of $1,000s right through here that it'll stay above $2.50 throughout the life of this contract. So that was an extremely bullish play on AEHR. But you can use this option flow filtering system to see what other options are out there and see what other trades you could take. If you want to go to the short side, you look for puts. But mainly you want to try to stick to one strategy, either be bullish or bearish, and try to learn how to read option flow, which is this right here, to help give yourself a direction. Guys, I hope this helped y'all out. I wish y'all a happy weekend, and I hope you learned a lot, and expect to see more videos in the future. Thank you.